Alright, so this is the second video for bond pricing and yields for BU 483 for the spring 2020 semester. And we're going to start off in this video going over bond pricing. It's something you've seen before, but this is just a little review. I'm going to show you how to calculate the value of a bond using a financial calculator. Specifically, in this case, we're going to use the TI graphing calculator, and then I'm going to show you how to do this in Excel as well. So a bond valuation problem consists of two time value of money problems. The first part of it is finding the present value of a lump sum. So this is going to be the present value of the principal to be repaid at maturity. And the second part is the present value of an annuity. And the annuity is the stream of equal interest payments. So in the example we're going to work through, we've got a corporate bond that pays $40 every 6 months as a coupon payment. It has an annual yield to maturity of 10% and 15 years to maturity. And we're going to determine the value of that bond today. So I'm going to go over here and demonstrate how to do this in a financial calculator. So I'm going to demonstrate first how to calculate the value of the bond using the TI-84 calculator. And we're going to start off by pressing apps, and then one for finance, and then one for time value of money solver. And my n is going to be 30 in this case because it's 15 years to maturity, and there are 2 payments per year, so 2 times 15 gives us 30 payments. Our interest rate is the yield to maturity of 10%, and this goes in the calculator as a whole number. Our present value is what we're looking for. Our payment is equal to 40 because that's our coupon payment. Our future value is our principal value, and that's $1,000. Our payments are equal to 2 per year, so payment P/Y stands for 2 per year, or 2 payments per year in this case, and then C/Y is compounding periods per year. So P/Y is payments per year, C/Y is compounding periods per year. As I move off of the C/Y is going to switch to 2 on its own. So now I want to go up and calculate the present value. So I'm going to press apps right here, or alpha, sorry, and then solve or enter down at the bottom here. And that gives me a value today of 846.28. So my value today is 846.28. In Excel, it's a little bit of a different setup. I'm going to use the present value function in Excel, so equals PV. My rate is my yield to maturity, so it's going to be 0.10. And in this case, we're going to divide it by the number of payments per year. So it's 0.10 divided by 2. The number of periods, our N, is still 30. The payment is $40. And the future value is 1,000, because that's the principal value we're going to get at maturity. And it comes out as a negative number on here, just like it did on the Excel, in the calculator. So we get the same 846.28 for our price today. So the next topic is premium versus discount bonds. And we're going to work through some problems as we do this. So the first question says, Bond A makes annual coupon payments based on an 8% coupon rate, has a yield to maturity of 9%, and a time to maturity of 7 years. What is the value of the bond today? So the value of the bond today, and I'm just going to use Excel for this because I can pull that up really easily here. So I'm going to put an equals present value. Actually, I'm going to do something a little bit different here. I'm going to put up here yield to maturity. And so the yield to maturity in your calculator is going to be the I variable. N is our number of payments. Yield to maturity, our payment, that's going to be our coupon payments. Our future value the payments per year, and then I'll find our present value, which is the value of the bond today. Okay. So our N, in this case, it makes annual coupon payments with a time to maturity of 7 years. So N is going to be equal to 7. The payments per year equal to 1. The yield to maturity is equal to 0.09 or 9%. The payment is equal to $40 or $80, and that's going to be the coupon rate of 8% multiplied by the face value of the bond, and we always assume, unless we're told otherwise, that that future value is $1,000. And so now I'm going to calculate the present value. So the yield to maturity divided by the number of payments per year. Our N is equal to 7. Our payment is 80. Our future value is 1,000. And we get 949.67. If you want to make this look a little nicer, you can put a negative up there to make it show the amount we're actually going to put in is $949.67. So bond A is a discount bond because the value of that bond today is less than its par value or its principal value. If the annual coupon rate is less than the yield to maturity, then the bond sells for less than the par value and is a discount bond. So then we've got bond B. Bond B makes annual coupon payments based on a 10% coupon rate, has a yield to maturity of 9%, and a time to maturity of 7 years. So the only difference between bond A and bond B is that bond B pays a higher coupon rate. So I'll go back to our spreadsheet over here. I'm going to change my payment from $80 to $100, and we get that again by taking the 10% coupon rate and multiplying it by the $1,000 face value or par value of the bond, and I get a value of this of $1,050.33. So bond B is a premium bond. If the annual coupon rate is greater than the yield to maturity, then the bond sells for more than the par value and is a premium bond. So that's the effect. Well, that's premium versus discount bonds, and really where that relationship comes up, where we get premium versus discount bonds has to do with the yield to maturity versus the coupon rate of the bond. Oops, I left in bond here. I'll just make it one bond. So the effect of time on bond values. If bond A makes annual coupon payments based on an 8% coupon rate, has a yield to maturity of 9%, and a time to maturity of 4 years, what is the value of the bond today? So I'm going to go back to our example here. The payment in this case is $80 because it's an 8% coupon rate. And then what's going to change is our time to maturity. We're going to go from 7 years to 4 years. And so the new value of that bond is $967.60. For a discount bond, because remember, we're just taking this A bond here and we're moving it up 3 years. We're saying 3 years has passed. So instead of having 7 years to maturity, now we're down to 4 years to maturity. As the maturity date approaches, the value of the bond increases. To the par value. So think about it this way. When we reach the maturity date of that bond, what you're going to receive is the par value or the face value of that bond. And so as we get closer and closer to that date, the value of the bond today is going to get closer to that $1,000 in this case that we're going to receive at maturity. For bond B, we have the same situation as we had above. A 10% coupon rate, a yield to maturity of 9%. But again, in this case, 3 years have passed, and so now there's 4 years left to the maturity date instead of 7 years. So let's see what happens here. And we see the new value of that bond is going to be $1,032.40. So we went from the bond being worth $1,050.33 to $1,032.40. For a premium bond, as the maturity date, I did it again. There we go. For a premium bond, as the maturity date approaches, the value of the bond decreases to the par value. All right. And again, for the same reason, on the maturity date, that bond is, if I own that bond, I'm going to receive $1,000. So as we get closer and closer to that maturity date, the value of that bond is going to get closer and closer to $1,000. So the yield to maturity is the interest rate that makes the present value of the bond's payments equal to its price. So for example, what is the yield to maturity of a bond that has a $50 semi-annual coupon payment? So we're going to receive $50 twice per year, a price of $1,087, a par value of $1,000, and 7 years to maturity. The first question here is this bond a discount or a premium bond? This is a premium bond because the price is more than the par value. Will the yield to maturity be more or less than the coupon rate? So let's go back up here where we had a premium bond. The yield to maturity was less than the coupon rate. So in this case, the coupon rate we know is going to be $100 because we're receiving $100 per year, or excuse me, is going to be 10%. The coupon rate's 10% because we're receiving $100 per year in coupon payments. And so the yield to maturity is going to be less than 10%. So the yield to maturity will be less than the coupon rate. So let's go ahead and calculate this. Again, I'm going to use this spreadsheet here. So in this case, we have 2 payments per year. Our N is equal to 14 because we have 2 payments per year for 7 years. The yield to maturity is what we're looking for. Oh, sorry about that. I've got to do this a different way. For this, I'm going to use the rate function in Excel. So my number of payment periods is 14. My payment is actually $50. I want to put that in here because I'm going to adjust. I'll adjust the rate for the outcome here. The present value is negative 1087. The future value is equal to 1,000. Oops. And this is low because I need to double this now. So my answer is 8.33%. So I'm going to go ahead and show you how to do this using the calculator as well. So again, we've got a bond that has a $50 semi-annual coupon payment with 7 years to maturity. So our N in this case is going to be 14 because there's 7 years with 2 payments per year. Our present value is negative 1,087. Our payment is equal to 50. Our future value is $1,000. Our payments per year are 2. So now I can just calculate the interest rate here. And so I'm going to press alpha. And then down here in the lower right hand corner, I'm going to press enter. And again, I get 8.33%. All right. So my answer here is 8.33%. To calculate the current yield, we take the annual coupon payment divided by the bond price. In this case, the annual coupon payment is 2 times $50 because we're getting that twice per year. Our bond price is $1,087. So that gives us an answer of $9.19 or 9.20%. In this case then, for a premium bond, the current yield is greater than the yield to maturity. And for a discount bond, the current yield is less than the yield to maturity. I just want to take a brief minute and show you a separate example on how this all works together. So let's go back out here to Excel. And I'm going to make a simple example in this case. I'm going to say we have a bond that makes annual payments of $80. The yield to maturity is, let's say, 10%. There's 10 years left to maturity. And so now I'm going to look for the value of this bond today. So the value of my bond today is equal to the present value. The rate is 10%. The N is equal to 10. The payment is $80. The future value, because we're assuming that all of our future values are $1,000, and so our future value is equal to 1,000. And so our value of that bond today is equal to 877.11, and I'll make this negative again. So that's how much you would pay out today for this bond. So let's see what happens, though, if we wait a year. So what happens 1 year from now to this price? So this is with 10 years. And this is with 9 years. Okay, so we're saying that a year has passed. Nothing else has changed. The yield to maturity is the same. The payments haven't changed, and they shouldn't change. And so now we're going to calculate the value of the bond with 9 years left to maturity. Again, my rate's 10%. My number of periods is now 9 instead of 10. My payment is $80. My future value is $1,000. And so now the value of my bond is $884.82. So what happened in between here? It went up in value. By $7.71. So now what I want to do is show you where the yield to maturity happened, the change in the yield to maturity happened. Excuse me, where the yield to maturity came from. So our current yield with 10 years left to maturity was equal to $80 divided by 877.11. So we received a payment of $80. We paid $877.11 for that, so that was our current yield. Our capital gains yield, this is the other part of the yield. This comes from the change in price. And so for this, I'm going to take our $7.71, which was the change in our price, divided by what we started with, our 877.11. So our total yield to maturity in this case is equal to 10%. So it came from the current yield and the capital gains yield. With a premium bond, so let me go ahead and change one thing here. I'm going to say our bond makes annual payments of $110 instead of $80. I'm going to change the amounts in here. Oops. Left 1 0 too many in there. That's not going to look right. And so my current yield, and I need to change this, is equal to 110 divided by my initial price here. And then my capital gains yield, it's just the change in price, negative $3.86, divided by my initial amount of $10.6145. So that again gives me 10%. So the change in price and the current yield will equal to the yield to maturity as long as that yield to maturity doesn't change. And it doesn't matter if it's a premium bond or a discount bond. And that's what I just wanted to show you with that example. Okay. So let's move on now to the yield to call. So we've got a bond that is callable that is currently selling for $987.50. It pays a semi-annual coupon based on a 7% annual coupon rate and has 15 years to maturity. It is callable in 5 years at the price of $1,070. What is the call premium? The call premium in this case would be $70. Because that's the amount that you're going to receive in addition to the par value of $1,000. So it's equal to 1,070 minus my original par value of 1,000. What's the yield to call for this bond? So a couple things to remember in this case is that our N is not equal to the time to maturity or the number of payments to maturity. It's equal to the number of payments until the call date. Okay, so in this case, it's callable in 5 years. There's 2 payments per year. So our N is equal to 10. So 2 payments per year for 5 years. Our present value is equal to negative $987.50. The payment is equal to $35, and that's because we're taking 7% of 1,000 and dividing that by 2. Our future value, and this is another thing that people often get wrong, is not $1,000 because that's the yield to maturity. That's for maturity. We're looking at the call date, and so our future value is $1,070. Okay. The payments per year are equal to 2. Right. So now I'm going to go over to the calculator and put all of these things in. So again, my N is equal to 10 make this a little bit easier for me. So my N is 10. I'm looking for the I. My present value is equal to negative 987.50. My payment is equal to 35. My future value is equal to 1,070. And then my payments per year are equal to 2. So I'm going to compute alpha, and then enter. And I get a yield to call of 8.47%. So does this answer make sense? Our yield to maturity, or in this case yield to call, is 8.47%. So our yield is higher than the coupon rate. And so this bond will sell at a discount because we want to make up the difference between the current yield and the yield to call or the yield to maturity by an increase in the value of the bond every year. So as time goes on, the value of this bond will increase because it's sold at a discount. And we're trying to achieve the 8.47% yield with only a 7% coupon rate. So the realized compound return versus the yield to maturity. What the realized compound return does is it includes the estimates for what we're going to do and what rate we're going to reinvest the bond coupons at after we receive them. So the realized coupon rate takes into account changing reinvestment rates over time. To find the realized compound rate, we find the future value of at the time of maturity, or when you plan on selling the bond, of the coupon payments yet to be received, compounded at the reinvestment rate and the price of the bond at the time. The coupon return is the return that makes the present value of that amount equal to the bond price today. Alright, so because of the math involved, I want to make this kind of a short example. So we're going to take a bond that has 3 years left to maturity. Pays an annual coupon payment of $70. The present value of the bond is $980. And the par value is $1,000. So what we want to do is we want to make an assumption about the reinvestment rate. So we're going to say that the reinvestment rate of this bond, or the reinvestment rate for the bond's coupon payments, is 10%. And so that's going to give us a timeline that looks something like this. At time 1, or the end of the first year, we're going to receive $70. Time 2, we're going to receive another $70. And then at time 3, at the time when the bond matures, we're going to receive $1,070. And that's broken up between $1,000, the par value, plus the $70 payment. So now what I want to find is what is the future value of these cash flows at time 3. My interest rate, the reinvestment rate for these cash flows, is going to be 10%. Now at time 3, we will have just received this $1,070, so there's not going to be any compounding on that money, but the calculator is going to take care of that for us. So what's the future value of these cash flows at time 3? I'll go ahead and do this in the calculator. So my n is equal to 3. My interest rate's 10%. My present value is 0, because we're not worrying about that right now. My payment is $70. I'm going to receive 3 payments of $70. 1 payment of $1,000. Oh, sorry. Actually, I'm going to put 0 in for this for now, because we're going to calculate the value of these 3 $70 cash flows, and there's only 1 payment per year. So I'm going to press alpha. So what I have in is n is equal to 3. The interest rate, my reinvestment rate is 10%. My present value is equal to 0. I'm receiving 3 payments of $70. I want to find the future value of those 3 payments at the end of 3 years. And then my payments per year are equal to 1. So the value of those $70 payments compounded at 10% per year is $231.70. So at time 3, I'm going to receive $1,000 par value plus $231.70 for a total amount of $1,231.70. So to find my realized compound return, I want to find the rate of return that I'll have received by investing at $980 at time 0 and then receiving $1,231.70 at time 3. So my inputs would look like this. N is equal to 3 because there's going to be 3 years. My payment is equal to 0 because I reinvested those cash flows. My present value is equal to negative $980. Oops. My future value is equal to $1,231.70. So that's going to give me my interest rate, and that's what I want to know. So I'm going to go back up here. My n is still equal to 3. My interest rate is what I'm looking for. My present value is what I paid for those cash flows, negative $980. My payment is 0 because I reinvested all those payments to get a future value of $1,231.70 at the end. So now I'm going to calculate the interest rate by pressing alpha and then going down here and pressing enter. And I get an interest rate of 7.92%. So my realized compound rate of return is 7.92% from that investment. The next calculation is the holding period return versus the yield to maturity. As long as the yield to maturity doesn't change, the holding period return will be the same as the yield to maturity. However, if the yield to maturity for a bond does change, then the holding period return will differ from the yield to maturity. So for this example, we're going to take a bond that has 5 years left to maturity. An annual coupon payment of $50, a yield to maturity of 8%, and a par value of $1,000. And like I mentioned before, all of our examples are going to have a par value of $1,000 unless I say otherwise. So I'm just adding this in here as a reminder of what the par value is. So right now the value of this bond would be so our n is equal to 5. Our yield to maturity is 8%, so I'm going to put that in here, 8%. We're going to find what our present value is. Our payment is $50. Our future value is $1,000. And so our present value, I'm going to press alpha and then enter, is equal to $880.22. So the beginning price is $880.22. So, and then we're going to let a year pass, and so we're assuming that the yield to maturity is not changing. So I'm going to change my end from 5 to 4 because we're saying that 1 year has passed. And so what's the value going to be in a year from now? So the new value is $900.64. And so now we can calculate our holding period return. So our coupon payment is $50. Our ending price is $964. Our beginning price is $880.22. And then we're going to divide that by the beginning price of $880.22. Alright, so again, I'm going to take my $50 plus, open parentheses, 964 minus 880.22. And so that's going to give me a value of $70.42. Then I'm going to divide that by 880.22, which gives me a holding period return of 0.08, sorry, ignore that second one there, of 0.08, 0.00000, or essentially 8%. Which is my yield to maturity in this case as well. So if the yield to maturity would change, that would change the ending price, and that would give us a different answer than the yield to maturity. So zero coupon bonds and Treasury strips. Zero coupon bonds are also referred to as original issue discount bonds and are sold at a discount and pay no coupons. The value of a zero coupon bond is the present value of the par value discounted back at the yield to maturity. U.S. Treasury bills are a common zero coupon bond. So what is the value today of a zero coupon bond with a $1,000 par value, a yield to maturity of 6%, and 6 months to maturity? So let's go ahead and take a look at the calculator again. So for this one, I'm going to go to apps, and then 1 for the time value of money. My n in this case is equal to 1/2 because it's 6 months. So I'm going to put in there 0.5. My interest rate is an annual interest rate, so that yield to maturity is an annual percentage. So we're going to make that 6. We're going to calculate the present value. Our payment is 0 because this is a zero coupon bond, so there's no payment. And then our future value, the value we're going to receive in half a year, is $1,000. So now I'm just going to press alpha and then enter. And I get $971.29. Let me show you one other way to calculate this, and this is using a present value formula. So our present value formula would look like this. Present value is equal to the future value divided by 1 plus our interest rate raised to the power of n, the number of periods. So this is going to be equal to our future value is equal to 1,000. Our interest rate is our yield to maturity of 6%, 0.06, and our n is going to be 0.5. So I'm going to switch over to my calculator again to show you this. So I'm going to take 1,000 divided by 1.06 raised to the value of 0.5. And I get the same answer of 971.29 cents. Okay. So a Treasury strip occurs when a bond dealer requests the U.S. Treasury separate the two cash flows of a U.S. Treasury note or bond. So we're going from Treasury bills, which are zero coupon bonds, to Treasury strips, which are not zero coupon bonds, or excuse me, Treasury bonds and notes, which are not zero coupon bonds. So you receive a cash flow in the form of the par value at maturity for these securities, and then you receive every 6 months a coupon payment. What a strip does is it takes apart those two cash flows. So you can have multiple different securities. As a result of this, you can create securities for each of the coupon payments. You can create a security that's just a stream of those coupon payments, and then a second security, which is the par value at the end of the at maturity for this bond or the Treasury note. So one security will be a zero coupon bond with the payment being the par value at maturity. The second security has payments consisting of the coupon payments. So what is the present value of a zero coupon bond with 15 years left to maturity if the yield to maturity is 5%? So let's go ahead and figure that first one out. The zero coupon, the value of a zero coupon bond with 15 years left to maturity, and we assume the zero coupon bond has a face value of $1,000. So again, I'll go back to my calculator here. So my N is equal to 15 years. Actually, it's going to be, N is going to be 30 in this case, because I want to show you what happens when we combine them both together. Our N is equal to 30. Our yield to maturity is 5%. Our present value is equal to 0. That's what we're going to look for. Our payment is 0 because this is a zero coupon bond. Our payments per year equal to 2. And so our present value, I'm going to press alpha and then enter, is 476.74. The second part of the question, if the semi-annual coupon payment is $20, what's the present value of the coupon payments? So again, I'll go back to my calculator here. And then I'm going to change this. I'm going to put the payment as $20. My future value is now equal to 0 because I'm separating these out. So the present value of those coupon payments is $418.61. Okay. So if I just took that bond before it was split and calculated it all together, I should get the sum of these two cash flows, or these two cash amounts. So I'm going to just put my future value here as $1,000. I've got my payment, my $20 payment's already in there. And so my value is $895.35. And if I add these two together, that's the amount I get. I get 4 plus 1 is 5, 7 plus 6 is 13, so I carry the 1. I get 7 plus 8 for the 5, carry the 1. 1 plus 7 plus 1 is equal to 9, and then 4 plus 4 is equal to 8. So we can see that the value of the bond consists of the present value of the coupon payments and the present value of the par value that we receive at maturity. So why do people strip Treasury securities? Well, sometimes they can find, you can find someone who finds an investor who just wants the regular cash flow every 6 months, but isn't interested in the par value at maturity, and another investor that's more interested in that par value at maturity. And so what the person who has the Treasury strips created can do is price them for a higher amount and receive a higher amount for these two separate cash flows than they could if they were just trying to receive to sell the bond on its own. So after-tax returns on zero coupon bonds, the IRS wants you to keep up on your tax payments and not wait until maturity to pay taxes on your zero coupon bonds. So let's go back up to here and just look at that strip where we're buying the present value of the zero coupon bond, and if we bought that today, it would be $476.74, and then after 15 years, we'd receive $1,000, and our capital gain would be about $523.26. Okay. So that's a big capital gain on that bond. Well, the IRS doesn't want to wait for 15 years to receive taxes on that bond, so every year you have to pay a tax based on the price appreciation of that bond during the year. The IRS produces a schedule for calculating that implicit interest income on the zero coupon bond for each year that the bond is held. So the next topic is bond ratings. Bond ratings provide a rough estimate on the likelihood of default and are a measure of the credit risk of the bond. So default is the risk well, actually, default is the occurrence of the bond payments not being made as agreed and or the bond issuer not complying with the provisions of the bond. So let's say, for example, that one of the provisions of the bond in the bond indenture says that the firm has to maintain a minimum current ratio of 2. Okay. If they don't maintain that minimum current ratio, they're in default. Even if they're making their payments on time, they're still in default. And the bond investor in this case can step in and say, okay, this is what you've got to do to make this right. Either you need to pull that number back up to above 2, or we're going to change some things about the bond to make it more favorable for the investor. But what's important to understand here is that default is not just not making your payment. Okay. So, for example, if you take out a car loan and it says that you have to, make your payments by the 1st, and we're going to give you a 5-day grace period to get your money in. Well, on day 6, you're in default. Okay, you're no longer complying with the agreement that you made with the bank, and legally that bank can then come and take your car. Now they're not probably going to do that because they don't want your car, they want your cash. But they're going to start contacting you, and they're going to start making arrangements with you to make sure that that gets paid, because again, they don't want your car back. They want the actual cash. Bonds and corporate bonds and the parties involved are a little bit more stringent because those bonds are often held by thousands of people. And so you can't just be one person making a decision. There is someone who works on behalf of the bondholders to make sure that the company is complying. The major bond rating agencies are Standard & Poor's, Fitch, and Moody's. Fitch is one you may not have heard of before. They've only really been popular for about the last 11 years. Fitch became more popular following the financial crisis. Standard & Poor's and Moody's had a lot of the mortgage-backed securities, or the mortgage-backed bonds, rated too highly. And a lot of bond investors lost money because of that. Fitch didn't make that mistake, and so as a result, they're kind of being seen in a more respectful light as a consequence of that. Bonds are classified as either investment grade or junk bonds. So here I pulled up the Wikipedia page for bond ratings, and you can see here we've got Moody's, S&P, and Fitch. And don't worry about this one right now. But we can divide ratings into investment grade and non-investment grade, also known as high yield because they're going to earn a higher yield because they're riskier, or junk bonds. For S&P and for Fitch, we can see the cutoff is BBB negative, and then we get down and we go to BBB or BB positive, and then over here the long-term bonds follow a similar rating pattern as S&P and Fitch for Moody's, as they do for S&P and Fitch. Below Baa3 and then the BBB minus for the other two, we have our junk bonds. These really didn't exist much before the late 1980s. At that time, a gentleman named Michael Milken, and he's still around, created these bonds so that companies that were riskier could still gain access to the bond market in order to raise funds. Prior to that, really the only bonds that were issued were investment grade bonds because investors weren't interested. They wanted lower risk investments, and so they focused on these low risk investment grade bonds. And then companies that needed cash but that were riskier usually didn't look towards the bond market to do that. Just what I want you to know from this is that these junk bonds or high yield bonds are riskier. And we can see down here with the S&P and Fitch, they do have D ratings, and that just means in default, that they're no longer making their payments as agreed. So investment grade bonds have less risk, and also some institutional funds such as a foundation or an endowment may have restrictions against investing in junk bonds. Holding all else equal, investment grade bonds have lower yields to maturity than junk bonds because they're less risky. So what determines bond safety? Well, the first thing that we'll look at is coverage ratios. These include the times interest earned ratio and the fixed charge coverage ratio. So the way we calculate those, the TIE, or the times interest earned ratio, is equal to the earnings before interest and taxes for a firm, or the operating earnings for a firm, divided by the interest expense for the firm. So this tells us how well the company can cover its interest expenses with its operating earnings. So higher is usually better in terms of default risk. Because the higher the number this is, the greater the firm's ability to pay their expenses based on the level of interest expense. The fixed charge coverage ratio can be calculated a number of different ways. I'm going to show you one common way to see it calculated. And that's going to be that the EBIT plus, and I've seen several different things on this. It can be, some places just put fixed charges, but really what we want is any fixed charges that are included in the expenses for the firm. So for example, we wouldn't want to use the principal payments that a firm has on its debts, because that doesn't come out of earnings, but we would want to include lease expenses. And we would want to include interest expense. We would want to include lease payments, and then oftentimes insurance expense is also included. And then the denominator would be the fixed charges of the firm. So the lease payments plus insurance expense plus the interest expense on top of those fixed charges. And again, from the viewpoint in terms of default risk, in order to lower default risk, we'd like to see this number be higher rather than lower. The second type of ratio that we would look at are the leverage ratio or the debt ratio. So the debt ratio, or again the leverage ratio, I'm just going to call it the debt ratio here, is equal to total liabilities divided by total assets. And then the debt to equity ratio you might see different ways that this is calculated. For our purposes, we're going to take total liabilities divided by the book value of common equity. And I say book value because what we don't want to use in this case is the market value of equity. So in terms of default risk, lower is usually better, because it means that they have assets or value in equity to cover their debts better. The third set of ratios are liquidity ratios, the current ratio, and the quick ratio. The current ratio is current assets divided by current liabilities, and the quick ratio is current assets minus inventories divided by current liabilities. So in this case, we take out inventories because they're the area of current assets that in general financial analysts have the least amount of faith in the values that we have on the balance sheet. Because, you know, if a firm is being liquidated, that means the value of their inventory may not be worth what they paid for it. And that's the value that we see on the balance sheet usually, is the historical cost. So if a firm is in that, you know, in the getting close to default, then the value of that inventory may be very, very little. If it's a manufacturer especially, that inventory may be part way through the process of being turned into a finished product, in which case it's going to have little, if any, value. So we take that out when calculating the quick ratio, because this really tells us how fast can we get cash and how much cash are we going to get if we're going to have to liquidate things very quickly. So higher is usually better. In terms of bond safety, because they're going to be the firm, if these are higher, are going to be better able to cover their current debts, the payments they have to make out using their liquid assets. And the next one are the profitability ratios of return on assets and return on equity. A profitable firm, one that's generating net income on its assets and equity, has less default risk. And then finally, the last one, cash flow to debt ratio. This is just the ratio of the total cash flow of the firm to the value of its outstanding debt. And again, higher is usually better. In terms of default, meaning that the firm has more cash relative to its level of outstanding debt, resulting in a lower chance of default for the firm. So the way that each of these affect that bond rating is that things that make the bond less risky are going to increase the value, or are going to increase that bond rating. In turn, whenever that bond rating gets higher, the yield to maturity for the bond is going to decrease and the value of that bond will increase. Higher bond rating results in lower yields to maturity and higher bond values. The indenture, and I mentioned it before, the indenture is kind of the agreement between the corporation and its creditors, or the bond issuer and its investors. It's also referred to as a deed of trust. The indenture usually includes the following. It's going to cover the basic terms of the bonds, how much is, the principal value, what's the interest rates, when is it going to be paid, any description of the property used as security, any repayment arrangements, if there is a call or a put provision, what is it, and then details of the protective covenants. So the principal value of the bond, this is the amount that is to be repaid at maturity. It's not necessarily the amount the firm is going to get when they issue the bond. If it's a premium bond, they're actually going to get more than the principal value. If it's a discount bond, they're going to get less than the principal value when they issue the bond. However, when they issue the bond, they try to put the coupon rate of the bond close to the yield to maturity for that bond, and so they tend to get close to a par value bond, and that occurs when the coupon rate is equal to the yield to maturity of the bond. Registered versus bearer bonds. Bearer bonds are kind of a rare thing, but I enjoy them. Registered bonds are bonds that are registered to the bondholder and usually held, I should say, by a broker or brokerage. So if I go out and buy a registered bond today, they're not going to actually send me a paper bond. It's going to be held in my Ameritrade or E-Trade or whatever brokerage account. And then the interest payments are going to go into that account as they're made. A bearer bond is a bond for which I would actually receive the physical bond. And as the holder of the physical bond, I would have the right to receive the coupon payments and then the payment of the principal at maturity. Who has physical possession of the bond has the right to the cash flows. So I like these because they're used in movies quite a bit. For example, Mission Impossible, the first one, I should say the first one with Tom Cruise, included bonds, bearer bonds, as one of the plot devices. The movie Heat, and I was just told this by a student in class, and I checked it out, and it's true. And then the third movie I can think of is one of the best movies of all time, and that's Die Hard. The quote-unquote terrorists were breaking into the building in order to get their hands on all these millions of dollars of bearer bonds. And again, the reason that they want to go after bearer bonds is because these bearer bonds are anonymous. They're easy to transport. So if you think about, carrying around or getting access to $10 million in cash, I don't care what denomination you're getting it in. The biggest denomination we currently have is $100. That's going to be a lot of cash that you're going to have to carry around with you. However, with a bearer bond, you can actually get $10 million in bearer bonds in very few actual physical notes. And so they're a nice plot device for movies. In the U.S., we don't really see bearer bonds very much. The U.S. government does not like bearer bonds. The IRS specifically doesn't like bearer bonds because they don't know who the payment is going to. They don't know who the payment's going to, and so it's hard to make sure that those people are paying taxes on the coupon payments and on the principal payments they receive at maturity. The security of a bond, this relates to what assets are underlying the repayment of or securing the repayment of that bond. And we can think of this as in terms of collateral. Collateral is an asset or assets sorry about that, an asset or assets for which the lender or bondholder has a perfected security interest to ensure the repayment of a debt. So for example, if you were to go out and take a loan today to purchase a car, what happens in the state of Kansas is you don't actually get the title to that car. The title to the car is electronically filed with the state, and your your lender will put a lien on that title. Once you pay off your loan, you can then request from the state to send you the title of the car with the lien removed. Okay? So the way that the lender perfects their security interest in your car is by putting a lien on it and making sure that lien is put on it, and then having the title held by the state until they send documentation to the state to remove that lien. And there's also a form you have to fill out once you pay off your loan, and then they'll send you your title. But that's one way to perfect a security interest in assets, to use them to ensure repayment of a debt. With other types of assets, with real estate, you're going to use a mortgage. And so this is referred to as a mortgage security when the collateral it's a bond that uses a mortgage on real estate to perfect a security interest in the real estate. And again, that's being used as collateral to back up repayment of the debt. Most bonds are debentures. And have no specific collateral, meaning that what's used to back up the value of that debt are the assets and the total value of the firm itself. So what happens is if a company has a debenture, a regular loan with no specific, a regular bond with no specific collateral, is if they go into bankruptcy and they're liquidated, then the bondholders would receive what's left of the value of the company after the employees are paid and the government gets paid and the accountants and the lawyers get paid. Then the bondholders would get paid by the liquidation of the assets of the company. And then if there's anything left after the bondholders get their money, which there usually isn't, but if there is, then that money would go to the equity holders of the firm. I've got a it says note down here. I'm going to take that out. That's just getting into a different type of a debt security, so we'll just ignore that. Seniority, if you remember back when we looked at, in the last video, when we looked at the JCPenney bonds, each one of them said that they were senior, either secured or unsecured, and that just refers to the ranking of the bond relative to other bonds. And so seniority refers to the order of payment for bonds. So since they were all senior bonds, they all have the same preference to being repaid. In other words, there's no difference amongst the bonds who gets repaid first for JCPenney. If you have junior bonds versus senior bonds get paid before junior bonds, meaning that, and we're going to use the next phrase down here, junior bonds are subordinated to senior bonds. That means that if whenever the bond payments are made, those interest payments are made, the senior bondholders get their interest payments first, and then the junior bondholders get their payments. And if the company has enough cash to cover all of those, it's not an issue. The issue comes in whenever the company doesn't have enough cash to cover all those interest payments. The firm might pay the senior bondholders their payments, but then the junior bondholders may not get all of theirs, in which case those junior bonds would be in default. So junior bonds or subordinated bonds are riskier than senior bonds. As a result, junior bonds should have higher yields to maturity than senior bonds because they're riskier. And that subordination also applies in bankruptcy for a firm. If a firm goes through liquidation, and that's Chapter 7 bankruptcy in the United States, those senior bondholders are going to get paid first, and then the junior bondholders are going to get paid next. For repayment of the bonds, the firm usually makes interest payments and then a lump sum principal payment at the end of the life of the bond. However, if you think about the bonds we looked at, and you might flip back over to those, for JCPenney, we had bonds that had a principal value of $400 million, $300 million, $500 million, really large amounts. And so as a bondholder, you might be worried that they won't have that amount of cash on hand at the time that the bond matures in order to make that payment. And you might notice that on some of those bonds that were coming due a little in the near future on that list that we looked at, some of them already had their principal paid down. And so what happens with a bond is oftentimes they'll have a sinking fund in which the issuing firm will put money into an escrow account during the life of the bond to make sure the money's there to pay off the bond at maturity. And what they can also do is actually start to repurchase those bonds, especially if interest rates rise and the value of those bonds decrease. They can buy those bonds back early to eliminate them off their balance sheet and to make sure that they're going to have the cash or they'll have the ability to pay off that principal amount before the due date or before the maturity date of the bond. So a sinking fund is an escrow account for which the bond issuer is required to make periodic payments to ensure that the firm will have sufficient cash to pay the principal of the bond at maturity. Not all bonds have these. In some cases, the plan for the business is just to renew the bond at maturity. So let's say that JCPenney issues a 30-year bond that has a principal value of $500 million. They might have the intention of never paying that bond off or paying that loan off. And what they'll do is that when that maturity date comes, they'll just issue new bonds for $500 million and use the proceeds to pay off that existing bond value. Protective covenants, these are put into place to protect the bondholders. A negative covenant is one that restricts the activities of the bond issuer. For example, common negative covenants include restrictions on additional debt, restrictions on dividend payments, and sometimes restrictions on certain business activities. So, for example, you could see a negative covenant that would tell a business that they can't change their principal line of business or what they do after they receive this money. And that kind of makes sense. You wouldn't want GM to decide to start building space rockets, okay? And that be their primary line of business after you've lent them money, because that's a riskier line of business. And you wouldn't want to, as a bondholder, you're accepting that risk. You're taking on that risk that they choose to take on. So what you're able to do to restrict their activities is to put these negative covenants in, saying that they can't take on more debt, or they can't pay out a lot of dividends, or they can't move into another line of business. The positive covenants are ones that require certain things from the company and that they do certain things. So a positive covenant is one that requires some action on the part of the bond issuer. These are commonly financial ratio covenants. For example, a covenant can require that the bond issuer maintain a minimum current ratio of 2 times. And if they fall below that, then that means that they're out of compliance with these covenants. Other covenants could require maintenance of the collateral and insurance on the collateral. But again, the main focus of positive covenants is requirements that the firm do specific things to protect the bondholder from risk. The yield to maturity and default risk. The default risk premium is the difference between the yield to maturity on a bond and a yield to maturity on a U.S. Treasury with the same maturity or the same time to maturity. So if we wanted to determine what the default risk premium was on a corporate bond, we would take the yield on that corporate bond and we'd subtract out the yield on a U.S. Treasury that has the same or nearly the same maturity date. So the difference would be due to the risk of default, since U.S. Treasuries don't have or are considered to be free of default risk. As the likelihood of a bond default increases, the default premium also increases. Holding all else equal, an increase in default risk will increase the yield to maturity on the bond and will decrease the bond price. our last two topics are just concerning two specific things, credit default swaps and collateralized debt obligations. So credit default swaps were initially a form of insurance purchased by large bondholders and banks that wanted to enhance the creditworthiness of their outstanding loans. The purchaser of a credit default swap pays the issuer an annual premium based on the risk of the debt and the amount of the principal of the debt. If the debt goes into default, the issuer has to pay the buyer for the loss of the bond value due to the default. So when I say issuer in that case, I'm not talking about the issuer of the bond, but rather the issuer of the CDS. So think of it this way. I go out and I buy a bunch of bonds. Okay? And I start to feel a little bit uncertain about whether or not that company that issued the bonds to me is going to go into default. So I can protect myself by going to an issuer, going to for example, an investment bank, and have them issue a credit default swap. And so what happens in that case is that they're going to issue that, and I'm going to buy that from them, and they're going to price it based on the riskiness of those bonds. So if those bonds that I own go into default, and I'm not going to get paid, the issuing the issuing party of that credit default swap is going to pay me instead. Okay, so it's kind of insurance on bonds, or for a bank, it's going to be insurance on their loans that they've made. If you watch the movie The Big Short, and I recommend that you do, especially now that you've got a little bit of maybe extra time. The movie The Big Short, the protagonist in that movie, and in real life, it was based on real events, went out and got CDSs issued based on the risk of mortgage-backed securities. And so these mortgage-backed securities were bonds that were collateralized with mortgage loans, and were essentially a securitization of mortgage loans where the bondholders received the cash payments made by borrowers who had bought houses using these mortgage loans. And he recognized that these mortgage-backed securities, were riskier than what they appeared to be in the marketplace. And he didn't own the mortgage-backed securities, and his investors didn't own the mortgage-backed securities, but he saw an opportunity there to take advantage of the increased risk that wasn't being priced in the market. And so he went to, and again, if you watch the movie, you'll see this, he went to these investment banks and said, hey, issue me these CDSs that insure against the loss on these mortgage-backed securities. And they laughed at him and they said, this is free money, because the idea of the time was that the value of these houses had been going up by a lot every year and would continue to increase in value. So if those bonds never get paid back, or if the mortgages went bad that secured those bonds, well, the issuer could just sell the houses for more than what the bonds were made for, or the debts were made for, and could pay those off easily. And so they didn't see much risk involved with issuing these CDSs, but they didn't take into account what would happen to the value of the houses in the housing market if a lot of people went bankrupt or went into default on their home loans. And so that's how the person in The Big Short made so much money, was that he got investment banks to issue these CDSs. The mortgage-backed securities went into default. They weren't able to pay back the bondholders of those securities, and since he had purchased this insurance product, he received a lot of money from those investment banks, and it actually drove a few of them out of business. The last is the collateralized debt obligation. So CDOs are created when an organization purchases a group of bonds or other loans. And the mortgage-backed securities that I mentioned before are a form of a CDO. So the bonds or other loans in this case would be the mortgages on the houses. It then divides these debts into tranches and sells investment into tranches as a standalone security. So what they would do, the investment banks would buy up all these mortgages, and then they would create investment tranches. So the top tranche would get paid first whenever the mortgage payments came in. Go down, and as you keep going down and down and down, the higher yield tranches at the bottom would get paid last. So if some people weren't making their mortgage payments, the people that invested in the lowest or in the lower tranches wouldn't get all of their payments. So the debt service on these tranches are paid when the borrower makes payments on the underlying bond or loan. The tranches are divided into tranches based on seniority. The senior tranche gets paid first, as I mentioned before. After it receives its payment, then the next lowest tranche gets paid, and so on. The most junior tranches are the riskiest because if the borrowers on the loans don't make their payments, the junior tranches will not receive all of their required payments. And so the yield to maturity on those lowest tranches are the highest because they face the most risk, and the yield to maturity on the most senior tranches are the lowest because they face the least amount of risk. So this covers the topic of bond pricing and bond yields. Please let me know if you have any questions about it.